A financial sell-off is a technical event defined by falling prices and declining liquidity. But at its core, a sell-off is a behavioral stress test. It measures the capacity of individuals to make rational calculations when the immediate data suggests rapid, irreversible loss. When markets stabilize, the focus shifts to asset returns. When they collapse, the focus shifts to human behavior. The environment is volatility. Everything is declining. Stocks are registering losses, and decentralized assets are retreating sharply. The immediate sentiment across the system is one of generalized difficulty. In this environment of fear, a specific question emerges. If you held $10,000 cash, ready to be deployed, what decision would you make? This is not a question about market mechanics. It is a question about risk tolerance under duress. The presence of cash during a crash creates an immediate, acute pressure, the necessity of choice. The cash represents a scarce resource that must be allocated now, at a critical inflection point. Failure to act, or acting incorrectly, carries a defined consequence. The potential reward is access to discounted assets. The potential cost is purchasing a decline that continues, erasing a significant portion of the capital instantly. The $10,000 cash is placed on a metaphorical table. The individual must decide on deployment, and they must justify that decision against the current noise of the financial system. This deployment choice forms the primary conflict of the sell-off.
The initial decision framework breaks down immediately into safety versus aggression. This tension reflects the cognitive dissonance between capital preservation and seeking maximum upside. The conservative approach targets safety, investing the capital into assets with established market positions, often referred to as blue-chip or big-name stocks. The rationale here is anchored in historical precedents. These companies have survived previous market cycles. This decision attempts to minimize risk by trusting reputation over current momentum. The expected outcome is a lower but more reliable return when the market eventually recovers. The aggressive approach targets assets that have been severely reduced in value, the crushed stocks. These represent companies whose current valuation implies a recovery multiple potentially higher than the market leaders. This decision is driven by the perceived deep discount. It is the pursuit of asymmetric risk, where a small investment could yield substantial profit if the market has mispriced the asset's long-term viability. But deep discounts carry proportional risk. What appears cheap may simply be correctly priced for inevitable failure. This is the value trap, a behavioral pitfall where the investor focuses solely on the percentage decline from the peak, ignoring the fundamental reasons for the collapse. The decision becomes based on hope for a reversion to the mean, rather than actual analysis of the company's future cash flow. The psychological burden of the aggressive choice is significant. If the choice proves correct, the reward validates the independent judgment. If the choice fails, the investor has actively participated in their own loss by choosing a higher risk trajectory. The individual must assign a weighting to these two opposing strategies: the steady reliance on the known quantity, or the high-stakes gamble on the profoundly discounted.
As the decision moves from quality of asset to type of asset, the pressure intensifies. The individual must now decide if the current decline represents a traditional economic cycle or a paradigm shift demanding different assets. The inclusion of volatile digital assets, specifically Bitcoin and Ethereum, introduces a fundamental test of belief systems. These assets lack historical context regarding surviving multiple decade-long downturns. Investing in these assets during a sell-off is not merely an investment decision, it is an affirmation of a belief in a future decentralized financial architecture. Contrast this with the traditional hedge, hard assets like silver or other precious metals. This is a strategy built on centuries of economic history, utilizing physical commodities as a store of value when fiat currency or public markets fail. The question posed during the sell-off is whether this traditional thinking is still relevant in a digitally accelerated global economy. Rejecting traditional hedges feels modern and forward-thinking. Embracing them feels cautious but potentially outdated. Simultaneously, the timing of capital deployment creates acute anxiety. The investor must choose between two vastly different approaches to mitigating timing risk. The all-in strategy demands total conviction. It assumes the current price point is the bottom or close enough to the bottom to justify the immediate deployment of all $10,000. This strategy maximizes the number of assets acquired at the lowest price, but it compounds the risk of catastrophic loss if the decline continues the next day. This is a high-conviction decision requiring the suppression of immediate emotional signals. The alternative is dollar-cost averaging, slowly deploying the capital over time, perhaps in 4 installments of $2,500 over a month. This strategy minimizes the risk of buying the absolute peak of the decline, but it guarantees that some capital will be deployed at higher prices if the market immediately rebounds. This choice prioritizes psychological comfort and risk management over maximizing immediate returns. The conflict between these two timing strategies highlights the human difficulty in accepting uncertainty. One strategy assumes control over the market's immediate future. The other explicitly accepts the lack of control.
Every decision to buy also implies a decision to avoid. During a sell-off, certain assets may exhibit textbook signs of being cheap. Low PE ratios, high cash flow, yet they are avoided. This avoidance is crucial for understanding risk psychology. The investor is forced to integrate recent, painful memory into the decision matrix. If a sector or specific stock caused large losses recently, the brain assigns it a higher risk weighting, regardless of the current fundamental data. This is loss aversion. The pain of a loss is felt twice as strongly as the pleasure of an equivalent gain. The $10,000 is withheld from the technically cheap asset because the individual fears the specific trauma associated with that asset class recurring. The consequence of avoidance is twofold. If the avoided asset recovers, the individual experiences regret, which is a powerful driver of future irrational behavior. If the avoided asset continues to fail, the individual experiences vindication, reinforcing the avoidance behavior, even if the underlying analysis was flawed. The sell-off also introduces the factor of social compliance. In a transparent financial environment, individuals are observing how others are deploying their cash. This creates informational cascades, following a perceived consensus, even if that consensus is based on emotional reaction rather than structural analysis. The pressure to conform to prevailing investment trends, whether towards perceived safety or radical aggression, can override independent rational thought. Regret is the inevitable emotional consequence of market timing. If the individual goes all in and the market drops 10% the next day, they must manage the immediate regret of not averaging in. If they average in and the market immediately rockets upward, they experience the regret of having left capital on the sideline. The challenge of the sell-off is the requirement to execute a strategy based on predefined rules, knowing that the outcome will be used to judge the quality of the judgment, regardless of the rules followed.
The $10,000 has been deployed. The immediate pressure of the decision point dissipates, replaced by the chronic stress of monitoring the outcome. The sell-off concludes, but the lesson remains. The real value of the sell-off is not in the specific returns generated,
but in the diagnostic data collected on human behavior under stress. The conflict between safety and aggression, the battle between historical hedges and new technology, and the struggle to time the market perfectly, these are universal pressures that emerge every time capital is put at risk in a declining environment. The questions posed during the sell-off reveal the core mechanisms of financial decision-making: fear, conviction, historical bias, and the difficulty of standing alone against market sentiment. The sell-off always ends. The market always recovers, or it shifts into a new, complex phase. But the individual faces the enduring problem, preparing for the next collapse. The only predictable element of a market crisis is that the psychological framework of the investor will be tested again. The decisions made during the prior decline, the moments of conviction, the points of failure, the assets avoided, will fundamentally shape the reactions to the next period of instability. The critical decision is not where to put the cash when everything is sliding, but how to structure the decision-making process so that when the next sell-off arrives, the investor can act based on cold calculation rather than the immediate pressure of loss. The systems that govern global finance are built on complex algorithms, but they are still navigated by human cognition, subject to the inherent limits of pressure and time. The cycle of fear and deployment will continue.